But you spoke a little bit about the debt super cycle. So super cycle has been mentioned on Up Only TV again. If you're watching in the chat, take a shot. But you talk about the debt super cycle, and we've been reached this point where over the last year valuations have gone crazy. Everything's pumped. Pokemon cards have gone crazy. Dog money's gone crazy. Meme stocks have gone crazy. How do you see the next few years playing out, given the scenario we're in now, with a bunch of things with like insanely inflated valuations, oil prices going up, food prices going up, etc.?
So I think most traditional macro guys thought that the next recession, which was the one we've just had, was going to be the end of the debt supercycle, right? It was all going to blow up. And everybody had been expecting it. And what happened is it didn't. And you need to ask why. So I looked at this, and you hear everybody talking about these bubbles, everything's a bubble. Is it? When you compare equities to gold, it's kind of pretty much in line with the last 100-year average, or real estate to gold, or real estate to equities, or any of this stuff. And I started realizing that none of those seem out of line. And normally it would show it. So 1999, 2000, equities looked way out of line versus everything. It was a clear bubble. So I'm like, are we looking at this wrong? Are we thinking about it wrong? And I started to think, you know what? I think we've got the wrong denominator, because I'd started using a chart of gold versus a basket of 27 currencies, not including the dollar. And gold would, every time there was kind of big QE, gold would ratchet upwards versus these currencies, trade sideways a bit, ratchet upwards. I'm like, this is interesting, because gold is telling me that these 27 currencies have basically fallen 65% since 2008. So then I thought, oh, maybe fiat money's the thing that's being devalued. And everybody's looking for inflation. We're going to see 20% inflation rates and hyperinflation. And maybe we're looking at the wrong thing, that it's the value of fiat money that's devaluing and making assets look expensive. So I multiplied all of these things out by the Fed balance sheet, or the G4 central bank balance sheets. And lo and behold, it all looks pretty sensible. It's kind of as you imagine in your head. The world changed in 2008, and we kind of wiped off a lot of performance of assets, and they've pretty much gone sideways ever since. And so I then went through all the assets and realized there was only two things that had actually outperformed the balance sheets. One was tech stocks, because they were all Metcalfe's law models. And we're going through the biggest technological revolution probably in all recorded history in the shortest period of time. And the other was crypto, which is part of the same story, but was earlier in its phase, and is seeing massive network adoption effects. So I think it was all to do with this denominator effect. So the debt supercycle, therefore, maybe it ends with a whimper and not a bang, because armed with this information, we're all migrating across to this new world of digital assets, where we've got recorded ownership, over collateralization, and a bunch of other stuff that makes it quite different. So if that's the case, then slowly, if we all transition over, you can basically wipe out the rest of it via the devaluation of currencies and other stuff, and it won't destroy people as much as it would have been without the new kind of digital asset system being built in parallel.
So how do you think that practically plays out in the assets that regular people, retail people, tend to be invested in? Like if you just look at the next 10 years of equities, for example, like do you think we have a Japan-style risk of just, going down, not making new highs, being sideways for a really long time? Or what do you think?
No, I don't, unless the Fed stops printing money, because we're going to debase the denominator. Now, will equities trade sideways versus the Fed balance sheet? Probably. Will tech stocks? Almost certainly not. They will almost certainly outperform, just because of the mechanics of what's happening right now. I'd call it the exponential age. We've got a bunch of these exponential trends all happening at the same time, from AI to robotics to EV to green energy to distributed computing power to crypto currency. I mean, it's a crazy amount of stuff that's coming. So I think that outperforms. As we transition to this new future, pushed by government stimulus behind it. Government stimulus is pushing all of this. So I don't see that. I think equity markets go a lot higher over time if we remain with the central banks continuing to use their balance sheet, which they have to do because there's too much debt. And if they step back, the economy starts slowing down again, and then they live in fear.
So in that theory, it's the cash hoarders who are really struggling, or maybe the bond holders who are really failing.
Yeah, and people thought the bondholders would fail because rates went up and they'd lose money. The bondholders are going to fail because they're compounding 2.5% returns or 1.5% returns. Meanwhile, the balance sheet's growing at 15%. So basically, their purchasing power, they're down 13.5% on their purchasing power. So if you're a baby boomer going to retirement, you're basically screwed in what you can afford in due course. Because assets, why do assets matter to us? Assets are basically future consumption that we park. So we park our money into Bitcoin and it gives us future consumption later, which is for retirement or to buy a house, whatever it is. All assets basically have the same attribute. And so if asset prices, if you're able to afford less of these assets because wages aren't going up and the Fed keeps pushing up the price of them, then your future ability to consume goes down. So you're all fucked in retirement. So you need to stay ahead of that trend.
Only.